Okay, we're here with our weekly insights with Doug Walters, our Chief Investment Officer. For those of you listening who aren't familiar, Doug and his investment team are responsible for our weekly insights article that's on our website, investstrategic.com. And the article basically takes a look at what's happening in the market from the week and our viewpoint on it at Strategic.
Yeah, and we like to tie it into our philosophy so you can understand how we think about the world.
Yeah. And I think for those of you who haven't read it, highly recommend it. In these podcast episodes, we'll basically touching on it a little bit and, covering a little bit of what Doug talked about there, but maybe expanding on different sections. And so if you want a larger view of Doug's insights, you can read the article every week. And so this being our first episode, Doug, I thought it might be interesting for you to kind of talk about and dive into evidence-based investing for the listeners. And it's something we talk about all the time. And I know you've explained it in different various content, but let's get it started with that. What is evidence-based investing?
Yeah, we'll start at the highest level, right? Evidence-based investing is almost exactly what it sounds like. It's basing your decisions on academic research and empirical evidence. And you might think, of course, why isn't everyone doing that? But a lot of investing is much more akin to speculation. So we like to say we focus on science, not speculation. Yeah. And it's not about, I don't see it as about taking big swings. It's about trying to tilt the balance in your favor multiple times. So looking at a bunch of small opportunities to tilt that scale in your favor, and those add up to hopefully 1-2% outperformance over time. And if you can get that every year, it can add up to quite a bit. You're talking about, millions of dollars over the course of someone's investing career.
Yeah. And, it's very much too saying, hey, we know X stock or X thing is super hot right now, and we are maybe looking at it, but that shouldn't be your whole portfolio, right? Like you should go like if Nvidia is way up, you're not going all in on Nvidia because the risk is so high that there could be a downside to that as well.
Right. There's multiple angles to answer that question. So one is diversification, of course. One piece of evidence that's proven time and time again is the importance of diversification, making sure you're not putting all of your eggs in one basket. There is, though, an element of where you would want to own Nvidia. There's something called momentum, right? That also is evidence. Stocks that go up tend to continue to go up. Again, you wouldn't want that to be your whole portfolio. You want to be diversified. But hey, momentum is something that potentially you could be including in your portfolio, along with these other things we call factors. Mm-hmm. So one you'd be really familiar with probably is value. Everyone's heard of value investing. Value is a factor. Momentum, like we've seen in Nvidia, is a factor. High quality is a factor. We like to have a diversified set of factors in our portfolio. These that are, again, evidence-based, proven, persistent over time, again, that hopefully can add a bit of performance to your portfolio.
Right. That if we took it from the viewpoint of strategic and in our plan, we talk about the great life. Like we ask all of our clients, like, hey, what's, when you're retired, you close your eyes, you think about day to day, what's your great life look like? And through the evidence-based investing, we're incrementally getting them to that great life. Safely, securely.
Right. Yeah, with we like to say with confidence and clarity, right? We want to make sure that everyone knows exactly how we're thinking, why they own what they own. They should be able to know what it's worth today. If we need to get out of it, they should be able to get out of it today, right? So just giving them that confidence that there's logic, there's reasoning behind everything we do. Mm-hmm. And hopefully that logic and reasoning leads to excess performance that gets them to that great life even faster.
Yeah. And so I think we touched on it a little bit, but how does that compare to like speculative alternative?
Yeah, the way I like to think about it, it's based on what we know today rather than what we think might happen in the future. Mm-hmm. So anytime you're talking about forecasting, whether you're forecasting companies' earnings or what the economy is going to do over the next 6 months, you're talking about the future. And the way I see it, the only way you see the future is with a crystal ball, and we don't happen to have one. So we like to focus on what we know today, right? We know those factors work. We know diversification works. We know that there's a lot of behavioral biases that can enter into investment decisions. We want to make sure we don't fall into those pitfalls. So it's about acting on what you know, not what you think.
Yeah, and I'm very excited for folks at home. You're going to hear over the next few episodes, and specifically later in this one, we're having Greg Medical on. We're going to dive deep into behavioral finance and talking about emotions and how they can drive our decisions. So really excited about that.
Yeah.
And for us individually, but also, I think that's something that affects individuals, but that can also affect companies as well, and groups of people, and you start getting into this herd mentality of like, oh, this is doing really well, we all should jump in on this, and it's not always the case, right?
Right, exactly. And the beauty of we actually in a way love these behavioral biases because that is how we can add value, and it is the reason why most of those factors we talked about worked, whether it's value, momentum. Those are based on behavioral biases. Why do momentum stocks work? Because of that herd mentality that that follows these stocks up and chases them. Yeah. Well, we want to capture a bit of that herd mentality.
Yeah, I think that's great. And so I think one of these biases too that we will talk about with Greg, but is the starting bias of like, hey, and this is something I know you want to speak about today, is like, when somebody first starts, they think they may be really smart because they made some good plays and they made all this money and they did something really genius-like, and how that plays into the long term. And so, I know this last Weekly Insights was really interested in covering that. And so,
yeah. Well, thanks. So we talked about geniuses and how when market's going up, everyone feels like a genius, right? You can't make a bad move. And, I have to say I was one of those geniuses. When I first had money to invest, this is back in the mid to late 90s, which is right about when the dot-com bubble was taking off. And sure enough, I felt like a genius, just like everyone else in the world around me did. Didn't seem like we could make a wrong move until we could, and the market collapsed. And even an index, relatively broad index like the NASDAQ, fell 80%, right? So suddenly, we had eggs on our face as these geniuses, and we found out, in fact, we weren't geniuses. We were just following the herd. And that really, that back then I was an engineer, hadn't quite made my transition to finance yet, but that really did shape my thinking as an investor and really started my journey towards evidence-based investing. Didn't hurt that, being an engineer, being, in science, certainly also helped shape my thinking that I'd rather be calculating than speculating. So, really interesting topic, and I think really quite timely. We've had a U.S. market driven by the Magnificent Seven that just seems to go up and up. We're starting to see, some cracks in that. And this year to date, U.S. market really is flat. One of the things I would point to in terms of evidence-based investing and what we've learned from those days, when I was a genius, is the importance of diversification. Yeah. And, there's been a lot of resistance in portfolios to be in small cap stocks which haven't performed as well, to be in international, emerging markets, and other asset classes that have lagged these Magnificent Seven. In fact, we've seen a lot of portfolios come into our house that, managed by others, significant concentration in U.S. assets. We prefer, and the evidence shows, you should be much more diversified than that. We're starting to see that play out this year. International stocks are up 10, 12%, emerging market 4%, gold's up 10%, bonds are up. Really the only thing not up right now is U.S. equities. Yeah. And I'm not saying we predicted that. We didn't. But we were prepared.
Right. Well, and it's always hindsight, right? Yeah. When something does well, you're like, see, I told you. Right. Yeah. And so when thinking about this, and for folks at home that, are clients of ours or looking at the market, I think tying it to that also in this world of news cycles and the internet, that a lot of times we can get hung up on what the hot commodity is in the moment, right? And I know like forums like Reddit and the news really drive these home to people, and the GameStop years ago is a perfect example of how this can happen. And so what would advice be for you for those folks who are going, oh gosh, this XYZ stock is way up, like or I heard from my nephew who's on Reddit that like this is going to be the next big thing. Like, how do I handle that as just a regular Joe and thinking about that?
Yeah, I think you really have to tune it out and ignore it. And I'd like to separate, sort of two trains of thought.
Yeah.
We're trying to get people to their great life. We're trying to invest their assets for their retirement or goals, whatever it is, way down the road. And, we want to be deliberate. We want to seek out those advantages in the market systematically. That is very different than, what's hot today and speculating.
Yeah.
And I don't discourage people if they have play money from doing that, because it can be a lot of fun. But you really need to segregate that part of your portfolio, the play money, from the portion of your portfolio that's trying to get you to that great life, that retirement, whatever it is down the road that you're looking forward to. Right. That needs to be a much more well thought out process, deliberate, in our opinion, evidence-based. And, I would just say, again, tune it out if you can.
Yeah, right. Yeah, that's like you don't spend your mortgage money on play, right? You don't
right, exactly.
Yeah. And I think that's super interesting. And so do you find like the timeline for folks should be looking out 10, 20, 30 years when I'm looking at my portfolio, for instance, like what's a good timeline that I should start looking at and going, oh, okay, I can kind of see the pattern and see what's happening with evidence-based investing.
Yeah, I would say at a minimum, you need 10 years. Think about a typical type cycle. I think over time, they've proven to be about 10 years. So 10 years would be, I would say, the minimum, which seems like a lot, but that's just the reality of it. Yeah. Most of us, when we think about our career in investing, trying to get to that great life, we have more than that, right? We have 20 years, we have 30 years. And for most of us, it's not just that retirement date. You don't stop investing the day you hit 65. Hopefully you're investing till that last day and then thinking about passing that legacy on to your kids. So investing can be almost, have an infinite timeline. That's why you really need to think long term.
Well, yeah, and I think one of the topics that I've seen us bring up a couple times, especially with that, is a lot of us, when we think about retirement or like how long we're going to live, I mean, we're speculating at that point, but saying like, oh, I don't know, maybe 75, maybe 80, but really you could live to 100. And so you kind of have to be prepared for that, not only for, for future generations, but just for yourself to continue living that great life that you've designed in your head.
Right. Yeah, it certainly doesn't stop at 65. And hopefully that's when, the real fun starts.
Yeah. So is there any like headlines or thoughts about maybe this past week or the week coming up or anything that you want to talk about in regards to that?
Yeah, I think the last week and the week coming up, we've seen a lot of market movement, a lot of market uncertainty. And I would say, it's really important during these times not to let emotions get the better of you. Most bad investment mistakes are made through emotion. So separate yourself from the news if you can. Continue to think long term, continue to think patience, and trust in the process, right? If we're investing evidence-based process for a reason, we trust it, we believe in it, we feel like we are prepared for whatever may come. We're not going to be investing based on emotion or the headline of the day, that's for sure.
Yeah, and so really encouraging folks that like if they want to check in, maybe it's more annually than day to day.
Yeah, there's a lot of evidence to suggest that those that are managing their own portfolios, that the less you look at it, the better it does.
Yeah.
So
Okay. Okay. Is there anything else we want to cover? No?
That's all I have.
All right. Well, thanks, Doug, and we'll see you next week for our next insights.
All right. Thanks, Jay. Have a good one.
This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.